Hey, folks, my
Thank
next
you.
guest did not waver from her bullish stance. Even when the street was beating that hasty retreat and telling you to get out of this market, she remained optimistic, in part because of technology. So I want to bring in Evans May Wealth Managing Partner Elizabeth Evans. And, you know, Elizabeth, although they have taken a lot of these names out to the woodshed this earnings season, you say the real story of this earnings season is corporate resiliency.
Good afternoon, Charles. It's amazing. 2/3 of the companies in the S&P 500 have reported, and of those reporting, 63% have beaten expectations. So that's meaningful. It's one of the highest numbers we've seen in the last 25 years. I've seen some naysayers say that the bar was set too low going into this earnings season, and it's fair. Earnings growth was expected to be 4% year over year, and right now we're tracking at 10.3% earnings growth. That's huge, especially given all the pessimism around tariffs and trade policy.
Yeah, and also, you know, I know you use this chart in your report to your clients, and the guidance, right? It's not just that they beat this low bar, but this guidance, right? Up guidance, 56%, just 29% in the first quarter, and on average since 2007, 46%. Just absolutely blown them away. And I guess that's why those who come up just a little bit short pay a heavy price. I want to speak more about earnings, but technology, communication services, obviously. These are areas that you've liked. These are areas that you said would carry the market. Communication services coming into the quarter, Wall Street thought they'd be up 29%. They're up almost 41%. Tech, instead of 16%, they're up over 21%. But there are a lot of these names are pulling back. And I guess the question here is, even with these huge beats, could you argue that the sector has been priced for at least near-term perfection?
Well, it's a great question, and I sound like a broken record, but we continue to believe tech will be the leader. Financials should also perform very well. And what I think is so interesting, Charles, is if we look at earnings so far, you mentioned all the sectors that have outperformed. If we look at the Magnificent Seven, and let's pull out NVIDIA, because we know NVIDIA doesn't report until August 27th, year-over-year earnings growth of those 6 companies is plus 26%. The rest of the S&P 500 is plus 4%. So that divergence continues, and we think that that trend will be here to stay.
Let's talk about some specific companies. Got about a minute and a half. I got to go Uber. I know you have a buy on Uber. They reported this morning. It's kind of been up and down. You know, they always give the CEO a pretty good interview. What I'm looking at, though, is a stock that's pulled back. It's under its 50-day moving average. I don't know if it's near term. It's a little bit of a yellow flag, but you like this long term. Why?
Well, Uber had an incredible report. They were right spot on earnings versus expectations, but they beat on revenue plus 18%. What I loved from the CEO this morning was not only did he tell us that the consumer is resilient, both here in the U.S. and abroad, but they have, in the last year, generated $8.5 billion in free cash flow. They're returning that to their shareholders. They've just announced a $20 billion share buyback. That's meaningful.
Meta is a name you like here, Elizabeth. Would someone not in the stock, though, chase it from where it is now? We're going to get a chart up here in a second.
Yes, we think for investors who don't own Meta or underweight Meta, there's still a tremendous amount of upside here. So we liked Meta going into earnings, but they just absolutely crushed it, both on revenue and EPS beat. What I think is super interesting about Meta is that their operating margins at 43%. Right. So that's a 500 basis point growth in the last year, which just underscores the leverage that they have. Got
less than 30 seconds, but I got to ask you about this Palo Alto Networks. It's gotten slammed here. And listen, I've watched this stock for a decade, and it does this from time to time. It misses and it gets annihilated. I guess what you like it here. You're doing some bottom fishing. Would the caution be that from time to time it might get hit?
Yeah, I think so. What's happened here recently is that it's pulled back since its announcement to acquire CyberArk, which is a $25 billion acquisition. So the market didn't like the price tag. Mm-hmm. Did they overpay? Perhaps, but we think it'll be accretive to cash flow in 2028. This is a great opportunity for a long-term investor. Goldman has a price target of $231 a share. It's about 35% upside from here.
Elizabeth, thank you. Appreciate it. Talk to you again soon.
Thank you, Charles.
All righty.